Okay, the YouTube Live is now streaming. Can everyone hear me well? Okay, I wonder if anyone else is... Okay, perfect. Alright, should we wait, I guess, 6 more minutes until 9 a.m. on the dot? Yep. I gotcha. Should I just put it in announcements? I feel like that would be a good spot for it here. Webinar. Pretty sure that's the link. Let's just try it out. Because that's the server URL. Yeah, I'm seeing the same thing. This is it. Give me one moment here. Okay, perfect. Yep, I see it. No, excuse me. There we go. Okay, perfect. That should link up to what we're able to see now. Bless you. Sweet. All right. Making sure everything's all good. And then I'll keep an eye on the YouTube Live chat comments because I don't know if anyone's going to be writing comments. Currently, there's only one individual watching, but I'll keep an eye on that as well. And then we got a little structure here, which is good. Yeah, let's do it. Are you, all right, let me come 1 second here. All right, and then let's do screen 2. And I think everyone should be able to see my screen at this point. Let's quickly check. Awesome, we got 7 people on YouTube Live, which is decent. All right, so let's get started. 9 o'clock. Welcome everyone to our first webinar. This is definitely something that we're going to hopefully implement in the future for a more reoccurring event. But for our first one, we're going to keep it a little bit short. We structured it in a way that is both educational, and then at the end we will have a Q&A session where you guys and girls could ask questions and we'll be able to provide you with some answers. I don't know if we'll be able to go through every single question that is asked, depending on obviously the amount of questions we have, but that will kind of be the structure of how we will go through this webinar. And mainly we'll be talking about BTC because obviously it is the main dominator for the assets within the crypto space. So yeah, my name is Keith, and obviously Nathan is within our webinar. So let's get started here. So the first thing I wanted to discuss before we even dive into the charts is just quickly what is trading, because I know we have some individuals within our webinar that may not know what even trading is. Maybe not. Maybe they've never even looked at a chart before. So basically, this is a real simplified version. But what is trading? Well, basically, how traders can profit from the market is looking for patterns that have occurred in the past that we can depend on to speculate on future price action. So these patterns need to be able to be dependable and also need to be able to duplicate, so we can test these types of patterns over and over again to see if they will yield profitable results over time. And just one more thing to note is people have the misconception when trading that traders have some crystal ball and they know exactly what's going to happen in the market. Although, yes, we do speculate on the price action either going up or down, but what we do is we basically have a pattern that has a percentage basis of it making money. So if we implement our strategy every single time over a series of trades, we will come up profitable, but we don't have an edge on any single trade, if that makes sense. So that's just one thing from a psychological standpoint that I wanted to discuss. And then now going into the actual trading aspect of it, talking about charts and candles and all this stuff. So we are a naked chart we're naked chart traders. We only analyze naked charts basically, and what this means is we don't use indicators. These things right here are called indicators. There's RSIs, MACDs, stochastics. There's a bunch of different things that are able to provide you information that is already shown within the chart. So what an indicator is it's basically a mathematical formula that gets its initial numbers from the price action, so the volume and the price action and the movement, puts it into a formula, and then outputs a certain data set that allows you to see the market in a certain way. Like for RSI, it's going to show you its potential overbought and oversold areas, but we don't use any of that. We just like to use the naked chart and understand the price action by looking at the candles and the tape. That's number one. Number two, we're just using major zones of support and resistance, ascending and descending trend lines. So this is a major zone of support or resistance, this single line. And let's just say I put it right there. What we're able to see is we have both a support and resistance where, let's just talk about support and resistance here for one moment before we dive in. So what is a support? Well, let's say the price is just ranging and it falls down to a key level on the chart, and then it holds the level, meaning it's not going to go below it. Like for example, this situation right here, that is going to be a potential level of a support where price is not able to go below a certain zone. There's buyers within that area, there's buyers within that market wanting to enter at this key zone. So that is a support. And on the flip side, a resistance is going to be the other way. So if this is a support with the price pushing down and then the buyers picking it right back up, the resistance would be the opposite. So the buyers are trying to push the price above a certain zone or a certain price, but the sellers are saying, no, this price we are wanting to sell at, we're wanting to short, we don't have confidence that the price is going to increase, and these are called resistances. And this is the main bulk of our trading structure and our methods, is using these key zones that we've seen occur in the past and speculating on them being still relevant in the future. So that's how we trade in terms of what we're looking for, and then also the system of how we trade. We're looking from the top down. So what this means is we are trading from the 1 week. So this is the 1 week chart indicating that a single candle is a single week's worth of data. And when we go to the smaller time frames, this single candle we can see all along here within every tick of the chart. This represents 1 week of data, and then when we go to the daily, that is 1 day's worth of information, and then 4 hour is 4 hours worth of information in each of these candles. So that's the simple understanding of what a time frame is just basically how many hours or how much time is in each of the candles that are represented within the chart. So we go from the weekly and then start working down, meaning we're going to go into the smaller time frames. So we're kind of looking at the market going further and further, going from the biggest time frame and the biggest macro view of it and breaking it down into smaller segments or areas within the chart that we can identify and use as potential zones of support and resistance. So we'll go from the weekly, we'll go to the daily, we'll go to the 4 hour, and then we'll end off on the 1 hour time frame to really give us that narrow view and give us the macro view all the way down to the micro, so we have a good understanding of what's happening on the overall time frame. So now that we have identified what we're looking for, we'll just actually draw some lines and discuss some technical analysis on the price action of BTC. This is on Coinbase, and this is on the weekly chart. So the first thing we always want to understand is our key levels of supply and demand within the bigger aspect of the chart. So what we're looking for is just horizontal zones that have proven to be significant, and on BTC we can see 2 clear zones already. The first one is going to be the previous high that we saw back in the summer of 2019, and we can also see it used as a key level of resistance and support as well. So let's just identify that zone right here. And that's our first zone. This is going to be our resistance area because we can see, let's just get our snip here and discuss why we chose this exact spot and not somewhere else. Well, on the way up, look at what we see. This is the first time the price has interacted with the zone around 11K. So initially, we got the candle to close right at the zone, so there was hesitation on the way up. And then what did we see? We saw the bulls to pick up the price right back up. So the price started to come down towards our zone, like we talked about for supports, but then the buyers, the bulls within the market, had bid orders at this key zone, and then it bounced the price back up towards the high, making higher highs and higher lows. So that to me signifies that there's bullish strength within the market right there, which is 2 indications. And then we saw another rejection. Also, a side note, very crucial thing that we always try to nail in for new traders is previous levels of support like this. So if this is a support, turns into new level of resistance. So if the price is respecting a key zone as a support or resistance, it's going to act as the flip side if the price breaks that particular zone. So in this circumstance, we initially held it for a resistance, we held it for a support, we held it for a support, and then we held it again for a new level of resistance. So we can identify that, yes, that is a key zone on the chart, and that's why we are extending this zone to the right. And we can also see, yet again, we saw the price respect this zone multiple times with wicks protruding above the zone. So we'll quickly talk about wicks in a second there, but overall, that's our key zone of supply where we have a lot of sell pressure within this zone. So then that is our one zone, because we need to find 2 zones that the price is playing within. We need to find our resistance and we need to find our support. So we found our resistance, now is going to be our support, and we can clearly see this zone right here. Although it's not perfect because the price did not hit the bottom of the 6K, we can identify this strong level of support right here. And this is what I mean by the price not hitting that zone exactly. We could move this above a little bit higher, so just the wicks of the body of the candle there is touching that zone, and I think that's what we will do today. So now that we have a key level of resistance, key level of support, we're now playing within 2 ranges. We're basically at the high of the range, and that's just the weekly chart. We can find some mid-range or midway zones of sensitivity, but we'll just stick to the daily chart as well. And obviously, if you have any other questions while we're going through the TA, please jot them down, and we'll be happy to answer them at the end, but we're just going to keep on continuing with the price action. So this is now the daily chart where each candle represents a single day, and we can identify that we have our strong level of resistance and support. So we're now just basically bouncing off these two zones here, bouncing from support and resistance within our key macro picture channel that we're able to identify for a key zone of supply and demand. So we see the price is coming up towards our zone, but let's first understand what happened previously to see what the market structure is, see what the flow is, because that is definitely very important. So just talking about market flow, which is basically series of higher highs and higher lows, or lower highs and lower lows, which will then create an uptrend, or it'll create a downtrend, or it'll create a horizontal zone where it's just consolidating sideways. And that's the three types of market structures that we're able to identify. So basically from the middle of 2019 until the end of 2019, we saw very, very clear, well-structured lower lows and lower highs. At the start of 2019, we saw higher highs and higher lows. This is a high, this is a low, this is a higher high, this is a higher low, this is a higher high, this is a higher low, this is a higher high, this is a higher low, this is a higher high. You know what it is. So that is market structure of higher highs and higher lows, indicating bullish structure and bullish momentum. We saw that on the first wave of 2019, and then the second half of 2019, we saw lower highs, which is right here. All these are lower highs, which we can create a descending trend line connecting those. That was a very poorly drawn trend line. And then we see lower lows forming right here. This is going to structure a bearish momentum because the lower highs and lower lows is signifying that the bulls are losing confidence and the bears are gaining confidence, because the bulls are not able to push up the price above a previous high and the bears are able to push the price below a previous low. So that was a bullish structure and then bearish structure. And then once we passed the lower highs like so, we will draw that trend line in a little bit more clear. But once we past this trend line, we then shifted to a new market structure. And we'll talk about trend lines at this point now, because it is come to a point where we will discuss trend lines. They are very vital for our trading methods, and what they basically are is drawing descending and ascending zones within a chart to find areas of confluence. So we have our two major zones. Let's just make these red and green. So we have the bigger macro supply and demand zones. So we have, that should be green. Give me one moment. All right, so we have our major zones of supply and demand, and then we also have drawn in our mid-range zone, or descending zone, sorry. So basically what was happening within this whole price action was, remember how we had that strong level of demand, which is going to be this green area right here. Well, the price was holding this pretty well, where we see 1, 2, 3 levels where price is getting, or the bulls are injecting the buy pressure into the market, where we see the price hold and get rejected 3 times, pretty significant level on the chart. We did not hit this zone exactly. Well, one candle we did right here, but overall, we do see that there is bullish pressure coming into the market, and then we see a descending zone keep the price below a certain area, making lower highs. We see this zone right here, and what this is creating is a squeeze in price, where basically there's a major descending zone, and then there's either a horizontal zone or an ascending zone that is squeezing the price closer to the apex, which is going to be right in the middle of the zone. And this is one of our edges that we have and that we like to trade, is the ability to understand which way the price is going to go by looking which way the price broke out of. So in this certain circumstance, we have a horizontal zone, which is holding the price above a horizontal level of support. And we have a descending zone making lower highs, squeezing the price towards the apex, which is going to be right here. So we could have squeezed in closer and closer together until we're basically right in the apex, which is this zone right here, and the price has to make a decision. Now, a little bit of a pro tip: if the price makes a decision sooner, it has more conviction, and whichever way it went, let's say, for example, in this situation, instead of coming back all the way to the apex, we broke out early, which is for me signifying that there is conviction and confidence in the break. So for in this example, because we broke to the upside, there's confidence and conviction from the bulls that will continue towards the upside. So once that squeeze came into play and then we had an initial break, this is where zones of confluence come into play. And what are zones of confluence? Well, it's basically just zones where there are major descending or ascending zones that line up with horizontal zones of support or resistance. And we'll just illustrate this right now. If you don't know anything about price action patterns, this is a clear reverse head and shoulders, which is a nice little price action pattern that we will discuss very shortly. But let's just draw that in and then take a picture of this again. So basically, we entered within this consolidation. Why did we look to enter in that particular consolidation? Is because we had zones of confluence where we have multiple areas within the chart that give us indications that there's going to be either buyers or sellers within the area. So just on this chart, we see two areas of confluence. I see one right here, and I see one right here. So let's talk about initially the first one, and then let's talk about the second one. So this first one right here is an area of confluence because of one, we see a descending zone connect lower highs. So there's going to be an area of sensitivity from that descending zone. We also see a previous level of support and resistance. We see resistance, support, 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 which will then create a perfect zone within the chart where the two lines line up perfectly together, which will create our zone of confluence. So that is confluence number A, is this area right here. And what we did to capitalize on this is we waited for the price to break our minor level of support, which was around 9K, retest it for a new level of resistance, and that's where we entered to make money on the way down. So that's how we capitalized on that particular move to the downside. And then talking about the next level of confluence, this guy right here. Why did we enter here? Why did it look like a good buy? There was two main reasons why we thought it was a good buy. The first one is the break of this reverse head and shoulders, where this is the left shoulder, right shoulder. So this is the left shoulder, this is the head, and this is the right shoulder. We can see a reverse head and shoulders here. Once it broke to the upside and then retested for a new valid level of support, that is our confirmation number one. Number two, why we look to enter here, our very dependable, strong level of resistance where the price held 1, 2, 3, 4, 5 times has now broken, signifying a shift in trend. So for us, in our method, we want to see on the bigger time frames, the 4-hour, the daily candle closure to really signify that the bulls are present, or for the break of the trend line, so we can assume that there's going to be a shift in trend occurring. We don't want to see, like we see here, little wicks protruding above the zone. We want to see large 4-hour candles, daily candles close above the zone, finishing its impulse move to the upside. Now, once it finishes its impulse move to the upside, we're looking to see a retest to validate the zone as a new level of support. We always want to wait for the retest, ideally, which let's say we have a zone right here, and then the price is just holding within the zone. What we want to see is, let's say the price breaks above. We want that pullback so we get a nice entry that we can manage risk with, instead of entering basically right when it breaks out at the high. And if it goes up higher, that's great, but if it pulls back, you have to put a serious amount of space in your stop loss in order to be able to still be in the trade and not get wicked out. And in order to actually manage that risk, it's definitely a lot harder than to just wait for the pullback. So we got our push to the upside, talking about the price action again. And then what we got after was a nice pullback, perfectly validating the previous level of resistance and previous level of support, yet again for a new level of resistance. So that for me is a major signifying move that we are going to still get momentum to the upside. I don't want to get too granular with our details, but we also look for injections of buy volume, which we'll get into the hour chart. But overall, that's why we were looking long at this point in time, because we saw so many zones of confluence where buyers were going to be located at that area, and then we saw the massive shift in trend. So that is quick technical analysis. I hope I'm not going too fast or too slow for everyone. Just going to quickly look at the questions that might be appearing on the YouTube Live. Doesn't seem like it. All right, so now we'll go on to the 4-hour chart to discuss a little bit more of the detail of what happened after the breakout. So let's get our picture here. So here's that reverse head and shoulders that we talked about, very, very significant on the chart. We saw a break to the upside, and then we saw a retest validating the previously broken resistance as a new level of support on our zone of confluence, because we can see this red trend line is going to be a new level of support because we broke as a previous level of resistance. So once that occurred, we got a bit of a consolidation, and we got our first impulse move to the upside. So what a solid, healthy, trending market does is make moves to the upside, strong pushes to the upside, and has corrections that are going to retrace back at a certain level from the initial move. And this is where fibs could come into play. We don't love using them because we can always just look at the previous price action to see where we could potentially see some levels of support. But that's why fibs can be potentially useful. But overall, we saw our initial push to the upside, and then we were looking for, well, we took profits all along here. We took 3 out of the 4 profits, and then we saw pullbacks. So when we're seeing these pullbacks, we're looking for key areas of support that the price could bounce at. And what we saw right here is initially we were holding this level of support right here at the $8,600 zone, and then we fell down below to this level of support where we had the previous level of resistance right here, test for a new level of support, and that's exactly what we got. And then again, we saw another squeeze of the price. Very similar situation right here, where if you zoom in and look on the hour chart, you get to really see the squeeze. But basically, it's a very similar structure where we're having a descending zone connect lower highs like so, and then we saw a horizontal zone act as a support. So the price was basically bouncing from descending resistance to horizontal support, and the price was nearing its apex, which is right here, which is something that we saw similar on the macro picture on the weekly chart of BTC. And then we saw a move to the upside, breaking the descending trend line, thus creating our move to the upside. Now, this doesn't mean that every single time we're going to get a break of a descending or ascending trend line that we're going to get a massive shift in trend, but from backtesting, if the trend line is very well respected, meaning there is 1, 2, and at least 3, if not 4 levels of dependency. That was a really not well drawn chart, but if we have 4 touches, meaning 1, 2, 3, if it's 3 touches, that means it's a potentially dependable zone, and if it's 4 touches, that means it's a very dependable zone, and we can use that area to risk off of. If we have those touches, like we see here, we can use that as a squeeze, and if the price breaks to the upside, yeah, then we're looking for longs, and that's a huge part of our edge, is being able to use that squeeze to understand where the price could go in the near future. So now let's talk about what happened after that point. So we got to move to the upside. Let's just break it down from the 1 hour now at this point, because we've already talked about exactly what's happened in kind of the recent price action in terms of 2020 and onwards, and then we'll just discuss what happened from basically January onwards from where we currently are now. So we got a nice cup and handle. We got a previous level of resistance turn into a new level of support right here. So basically what we've been doing is just basically breaking resistances, holding supports, seeing higher highs and higher lows, and that's why we've been bullish basically since the start of 19 when we initiated that bullish move towards the upside. We've been seeing strong moves from the bulls, really signifying the strength and the conviction that they are still pushing the price higher. So this is what I currently see right now in my charts. Let's just, I think this was a key level of demand, actually. I don't know why it turned back to gray. So we got our major supply zone, which is right around here, and then our major demand zone, which is right around here. And we'll just talk about what's been happening on the hour chart within our major zone. So we got a nice cup and handle here. So we got our initial move to the upside. That was a really poorly drawn thing. So we got a move to the upside, and then we got our cup and handle that pushed the price back up. So we got our loop. This is our descending trend line that we talked about. The price broke out of it, retested a little bit, and then moved to the upside, retesting the previous resistance. We can see that right here. Once that occurred, we got basically an instant move, breaking the previous resistance, and then look at that. We held that zone very perfectly for a new level of support. We can see that right here. And then yet again, we did the exact same thing. Once we had a new strong level of resistance, we tested right there for a new level of support, and then we held that zone within a new consolidation. Previous ceiling equals new floor. So that's basically what's been happening from 2020 onward. We've been breaking resistances, holding supports, making nice staircase patterns overall. So in my eyes, I'm looking at the price action in a bullish fashion. I'm looking for longs in this market. I want to see the price appreciate some more until we hit our major key supply zone, which is looking back at the daily. We can see why we're looking at this potential zone for a area of sell sensitivity. So I'm going to stop it there for a little bit. I don't want to go too long, but I hopefully gave you some information, some insights, and some understanding as to how we use our methods to trade in the markets. Definitely, yeah. Algos are not bad. Like, I don't have a whole lot of experience trading with algorithms, but talking to individuals who have had experiences with algos, it's great until the market changes. Like, let's say you have an algorithm that is able to trade in a very bullish market, seeing nice, clear, higher highs and higher lows, then the algo might work. But then if you are trading in a bearish market or in a consolidation, that algo is going to be scalping shit trades and going to be basically losing you money unless you have an algorithm that is able to shift its trading system and its decisions based on the market structure, which I personally don't know of an algo that is able to do that. But I'm sure if you're talking to some very high-class Wall Street traders that have billions of dollars backing them, they probably have something like that in the equities market. But yeah, we're not going to get into that too much within this video. So yeah, I hope I illustrated the way we trade in a simple, easy to understand, digestible way. We're basically using horizontal zones and ascending and descending trend lines to find areas in a chart that show that there is levels of buyers within the area, or that we could potentially speculate that there's going to be buyers or sellers within the area. So like we're pretty transparent in the way we go through the market analysis. We will basically go through each trade that we are currently in, that we recently took, or we're thinking about taking. So if you have any questions whatsoever while we're actually going through it, put a question down in the comments, and obviously we'll be able to help you out in any way we can. Yeah, sure, that works. Yeah, that's not a problem. Let's see what else we have within our top-down analysis. Okay, so risk management. This is definitely something that is very important in really any type of trading whatsoever. So risk management is basically understanding how much money you're going to be losing at a certain point in time. I think this one's going to be more of an audio quick mini lesson. But what risk management is basically just getting your long short position and understanding how much you're losing, but then also if you're taking multiple trades, how much you're losing if you lose all those trades. So quickly, I'm just going to talk about a potential trade that you could have taken or something along the lines of here. So let's say you had a nice double confirmation of a support, and then you enter, let's say, just like somewhere around there. I don't exactly know, but let's just say in this example, that's where you entered. So risk management is, yes, it is how much you lose, but it is more to do with, in my opinion, risk reward, because that in itself is going to either make you money or lose you money. Win-loss ratio is important, but in my view, risk reward is more of a factor to determine how you're doing as a trader, because win-loss, you could be losing less than 50% of the time, but if your risk reward is based at 3 to 1, 4 to 1, even 2.5 to 1, you're still making money. So The number one thing I say to traders is to have a risk limit. So what I mean by that is we can see that in this certain circumstance, this percentage right now is, let's see what it is, 3.45, right? So this is 3.45%. And we want to be able to manage our risk. So instead of just trading $100 each time, you want to ensure that, let's say you want to lose max $50 at each time. So instead of just putting $100 into this trade, depending on this risk, you would change your position sizing so you're max losing, let's say, like $50 or $100 or $1,000. It doesn't really matter. But what risk management is understanding the total value that you're going to lose before you even enter the position. That is foremost the number one risk management parameter that we as traders need to understand, and we need to know how much we're going to lose in any certain circumstance, which is going to be the max loss. That's number one. And then number two is going to be if you're taking multiple trades, how are these going to add up? So if you're risking $50 here, $50 on another trade, and then let's say $60 on another trade, and they're all long, meaning they're all trying to make money when the price is going up, you're going to be losing a significant amount of money if all three of those trades go down. So that's definitely something to keep in mind. And then the last thing for risk management, I would say, would be when you are taking, I guess, small losses, let's say 3, 4, maybe even 5 times again, that is called a drawdown. So if this, let's say if it's a P&L curve is like this, maybe you guys don't know what a P&L curve is. So basically, let's say you take 20 trades, right? You take each trade one by one and you take a series of 20 trades. There is a good possibility that you could have a series within the sample size that has 3 losses in a row or 4 losses in a row, right? That is, in the infinite possibilities of 20 or 30 trades, is a very, very plausible outcome to appear within that sample size. So what we're looking to do is be able to take on those losses, 3 losses, 4 losses, without severely impacting our capital or our portfolio in general. And this is a little bit challenging. Let's say you're risking 10% of your portfolio. Let's say you are, let's say you have $100 of your total portfolio and you're risking $10 each time. If you lose 4 trades, you're really, really deep in the hole. But if you're risking 2%, now it's a lot more manageable. Let's say you lose 3 times in a row, max at 2%. You're losing only 6% of your whole account. Whereas if you're risking 10% of your whole account each time and you lose 3 in a row, well, then you're down 30%. So yeah, you won't be able to grow as quickly, but as people here starting early, just starting their trading journey, the most important thing in my view as a beginning trader is preserving your wealth while you're growing it. And it sounds counterintuitive because the whole point of trading is to make money and to multiply it. But as you're starting, it's definitely a long game. Like, you're not going to become a millionaire in a month if you're trading with like 10K. Like, it just, the math doesn't add up in a way that's able for the individual trader to actually manage risk. So let's say you're risking 2% maximum on a total trade by trade basis. You're not going to be making like 500% gains, but a 10% gain in a month, a 15% gain, even a 20% gain in a month is very, very doable, and that's what I think people should be aiming for, is not these outrageous 100% gains in a single month. Like, it can be done, right? 100%. But think of the risk that it needs to take in order for that portfolio to reach that crazy gain. And I think when the bull run comes in, we won't take profits right away. We'll set stop losses always. We always set stop losses, hard stop losses, meaning if the price comes down and just touches this price, instantly I'm going to get taken out of the position. I don't have a choice. I will not I will not ever set a stop loss, basically. So if I ever enter a position, there's no way in hell I will never not set a stop loss that will take me out if the price goes below a certain point or above a certain point. That is rule number one for me. I never ever enter a trade and I don't know where I'm getting out. Okay, so I got a quick question here. This is basically completed with the risk parameters. 2% risk, very important, and also understanding the drawdown that you'll have, understanding how many losses you'll take in a row, and being able to incur that within a regular, healthy sample size is very important. So understanding that you don't want to risk too much in any single trade is basically the overall point I was trying to make, and that just all comes down to how much you're risking per each trade, as well as how your drawdown is, and understanding the worst case scenario for your portfolio, and if you're able to weather the storm is basically the risk management that we need to understand as traders in a nutshell. So the next question is, Lewis asked, apart from TA, which tools do you use to understand possible causes which could cause a movement on the market? So yeah, we do have a couple things that we use in order to analyze the price action. The first one is definitely, oops, not that one. The first one is definitely going to be, I'll just show you, the BTC longs and shorts. So what this illustrates is the percentage of people that are long and short the market. So we go over two main tools that we use within the market in order to analyze the price action as well as the direction of the momentum that it could potentially be going in the future. The first one is definitely going to be the BTC longs on just Bitfinex. So this is only going to be showing the price movements, the short-long data on Bitfinex. And we have another tool that we use for the different exchanges that we like to look at, but this is a great illustration of the short longs within the market. So we see right here, this is basically right before the start of 2020. We saw a massive influx of buy pressure push the price up above our previous level of resistance. We saw an immense amount of buy pressure come into the market, signifying bullish strength in the market, and that's what initiated our bullish push of 2019. We saw a lot of discrepancy between buyers and sellers in the market. And then we had a sell-off that brought some consolidation, but overall, we saw the previous level of resistance turn into a new level of support. TA can be basically drawn on any chart that has a market. So like any chart, this can TA can be utilized for this chart. So we saw a nice level of resistance turn into a new level of support, and now we're seeing higher highs and higher lows coming into the market. So just using this particular tool, we can see that there are the confidence is more geared towards the bull side. It's more weighted toward the bulls. The buyers have more conviction and confidence because A, we're looking at the TA, breaking resistances, holding supports, making higher highs and higher lows. And on here, we see that the previous resistance is now our new low, indicating that the bulls have gained a significant new level where buyers are not able to hold the price below. So we're making the lows here. So this is a low, this is a low, and then we could see another low higher up, kind of like here. So we're making those lower, higher highs, higher lows, something like that. So that's one tool that we use to identify the market and which way it could potentially go. And then the other is going to be the, oh, sorry, go on. Yeah, definitely. Thank you very much for that, for the input there. So I definitely didn't illustrate that in the best, but thank you very much. And then another tool that we use, very similar to this, but we're not actually seeing a chart represent the data. It'd just be two data sets, basically. One that is going to illustrate a 24-hour period, and then one that will illustrate in a 1 hour period. Exactly how this is, except on different exchanges. And we go through this in a lot of our Bitcoin analysis videos or Bitcoin market videos, but this is mainly what we're going to be looking at. Is we have the 24-hour longs versus shorts. So this is a percentage of people that are wanting the price to go up versus down. So it's basically like the comparison versus people that want the price to move up and they're making money versus down, and it's a good comparison overall because we get to see 3 different exchanges. We see BitMEX, Binance, and Bybit, and we mainly are looking at BitMEX, Binance, and Bybit because they have the 3 highest volumes, with BitMEX being significantly greater, basically double than the level of Binance, and significantly greater than Bybit. So just quickly looking at what we're able to see right here, we're looking for the 24-hour and the hour. On the 24-hour, we see that BitMEX has a higher percentage of people that are longing. So on BitMEX, basically, there are more people wanting the price to go up in value than down. More people are betting that the price will go up on BitMEX, which is the highest volume exchange, which to me signifies that there is more bullish conviction and more confidence in the market. On Binance, not a huge discrepancy, 50.9 for the longs and 49.8 or 08 for the shorts, and then Bybit is basically exactly the same. And then looking at the 1 hour on BitMEX, there is more longs, 54.56% of people that are long and 45.4. So I'm not going to go through the whole thing. I do this basically every single time we have a Bitcoin market analysis, where I go through the different tools that we use as well as the top-down approach that we have for our trading methods. But that is how we analyze the market. We have these 3 tools. We use the price action charts, top-down analysis. We have this, and then we also look at the long and shorts within the market. And also looking at BTC dominance is also going to be another key player. And sometimes I also look at the fear-greed market, which is this guy right here, the fear-greed index. Let's just bring it over. So we have basically a fear-greed index that shows where the market is. I don't love looking at this, but it does give you some where they're getting their data, so data sources. So it's in volatility, market momentum, social media, surveys, dominance, and trends is what they're going to be tracking in order to get their fear and greed index. I sometimes look at this if it's very, very fearful or very, very greedy, like if we were back here or at the lows here, then I'd be looking at it potentially. But if we're kind of in the middle, playing somewhere not really greedy, not really fearful, I don't really look at it. But that's something to also understand if it is a big shift from one side to another. And that's mainly what I really look at. I don't really look at much else in terms of what I analyze for the daily BTC analysis. So dominance, the fear and greed, and then the percentage of long and shorts both here, and also the coin farm website that we have here. So that's what we use to analyze the markets. Hopefully that answered your question, Lewis. Hedging, golden crosses, any other things that we want to discuss? Hedge, yeah, we could discuss that right now if any other individuals have any other questions. Doesn't seem like it. Okay, so hedging is pretty simple. What a hedge is basically going to be entering 2 different positions. It's going to be opposing directions. So let's say you want to long on this particular trade. You want the price to go up on this particular trade. Well, at this point in time, let's say you are not 100% certain that the price will go up, and there is some possibility that you think that the price will break out here and then break back down below our support and start a move to the downside. And you want a little bit of insurance because you've already put your long entry here. And let's say this is losing you like, I don't know, like $50 or $100. So this in itself is a $50 loss if it does not go your way. And you think that if the price is going to go back down, it's going to really aggressively move back down to a key level of demand. So you want to be able to be insured in case that happens. Well, what you could do is, let's say you put a long position in on BTC. What you could do is put a short position, risking a little bit less on, let's say, Ethereum or another pair that is correlated with BTC. So if BTC does go down, you're also going to make money. So let's say in this particular trade, your risk reward is 3-1 or 2-1, and in this one, you're risking $20. And then you could be making, let's say, $60. right? So this is your risk reward. It's a 3-to-1. And then we can see this rewarded, let's say this win, if you do win, is let's say 150 bucks. So what we can see here is if the BTC, this is Ethereum. Oh, that's a really bad E. Just give me one moment here. My mouse is a little bit hard to write with. Okay, so Ethereum. So we can see right here, this is the main trade. So this is the main. And then we have a secondary, which is our hedge. So this is our hedge. So what we're looking for is, ideally, we're looking for the main trade to work, obviously. Then if the main trade works, we're going to be losing 20 bucks, right? So because the price did move to the upside, this Ethereum trade is correlated with our main trade, and we win 150 bucks, but we lose 20 bucks because the hedge hit our stop loss, but then the main took out the take profit, so the market went in the same direction. Just a reminder that these two trades that we're hypothetically taking are correlated, meaning they move in the same direction or similar directions, right? So if we're winning on the main trade 150 bucks, we're losing 20 bucks. So in a hedge, you're always going to be losing a little bit and gaining a lot, or losing a decent amount and then making a decent amount to cover what you lost. So you're going to always have a plus negative, where you're not going to have just a single trade where you're going to go down negative. You're going to have two trades working, opposing each other. So you're going to have your portfolio discrepancy kind of move in tandem with the P&L of the two trades until one of them hits a stop loss. So option number one for this situation is the main trade wins and the hedge loses. So we're going to be making 150 bucks and losing 20 bucks. Basically, that's option number one. Option number two is if we have the main trade lose, which then the market goes down. So then we're looking for the hedge to actually make us money, or at least cover the losses that we took. So let's say the market goes down, which means the main trade that we have right here will lose 50 bucks because that's what we initially looked to risk when we put on this trade, right? So that is instant 50 bucks gone. All right. Our hedge will actually be covering our total loss in this situation because our take profit is at $60. We had a risk reward here that was pretty good, which gave us the ability to make 60 bucks while losing 50 bucks. So we came out of this situation profitable, not by much, but by 10 bucks because we won 60 bucks in our hedge while we lost 50 on our main trade. Whereas in that exact same situation, if we did actually, if we were right in the main analysis and the main trade was right, we then lost only 20 bucks and gained 150. So you see that this strategy allows you to be insured in case you're wrong. So then, like, it's like car insurance, right? Let's say you get into a major car accident and you hurt someone. You don't have to pay for their whole bill. Like, let's say that person, like, I don't know, broke his back or something, and then his medical bill is going to be like $1 million. Your insurance is going to cover that $1 million because you're paying monthly that $300 bill or whatever it is in order to get covered in case a shitstorm like that does occur. Very similar with this. Let's say you put on a hedge on every few times or even every single time or whatever. You're going to be paying that $20 bill. You're going to be paying that small fee to get covered. So then in the case of an actual shitstorm coming and then you're losing your total amount, you still are able to make a little bit of money and not be losing 50 bucks because you have the hedge that's going to cover for your 60, and then you're going to be able to make a little bit of money. So that's kind of what a hedge is it's an insurance that allows you to take a little bit more risk than you want, because if you're wrong, you still have the option to get a reduced risk or even potentially even make a little bit of money because you've strategically strategized your hedge in order to capture the move to the downside if you are wrong. So hopefully that gives you a good understanding of what a hedge is. Did I miss anything, Nathan? Do you think I can add anything to that? Definitely. All right. There's a couple other questions. So we got either the potential golden cross to go over, and then also Lewis asked. He also said, "Thank you. You're welcome." So he asked another question: how do you choose which asset to trade? Do you look at the volume of this asset and trade the one with the highest volume? Do you also look at the fundamentals behind the asset? Which one should we do first? Golden cross or that question? Oh yeah, that's true. Yeah, that's very true. Okay, so how do you choose which asset to trade? So basically, I hope you're talking about like in terms of asset class or different pair, because there's assets within the cryptocurrency pair and there's also different asset classes. So I'm going to assume that you're going to ask which asset you're going to be trading within the cryptocurrency market, because if you're going to ask which asset class you're going to be trading, that's a whole other question. You got to understand what asset class you're even getting into. If you're going to be trading futures, crypto is different from equities. Equities is different from forex. Forex is different from many other things, even like if you're trading bonds or T-bonds or whatever the case may be. So anyway, I'm going to assume that you are asking which pair I trade within the market, which asset I trade within the cryptocurrency market. So a bit of an open-ended question. Yes, we do look for volume, but it depends what we're looking for. So we have these main pairs that we're looking at, and we trade these both long and short. So we're just looking for nice market structure with a key price action pattern within the market structure that we can use to have some dependability for the price action pattern. So the first thing is just looking at the market structure, right? Like within any Forex pair, we're not really looking for major catalysts, but we're looking for key zones on a chart where we're having some dependability. That's number one. It's kind of like Forex. Yes, you do look at the fundamentals to some degree in Forex, but we're just looking at market structure, key zones on a chart. Like for example, when the price goes up to our main supply zone, yeah, we're going to be looking for shorts and stuff like that. For example, in this structure right here, let's just talk about it. You're not really looking for fundamentals or anything at this point in time. You know, you see a nice descending triangle. You know, you're going to short at the highs here. You're going to short at the highs here. When it breaks down below a support, you're going to be shorting. You're going to look for retests. It's just simple market structure is what we use for the main pairs. So we're going to talk about BTC, we're going to talk about Ethereum, Ripple, Litecoin, Binance Coin, Dash, Chainlink. Yeah, so these types of coins are going to be more or less just looking at market structure, not really seeing like peak volumes or catalysts, but we're basically looking for the dependable patterns that we're able to capture profits off of. That's going to be number one. And then we also have another way of looking for coins, and this is how we used to kind of do it. So before, I'd say middle of 2019, kind of starting spring of 2019, what we used to do is I personally mainly looked to trade very volatile, fast-paced day trades on smaller cap alts within both the BTC pairs and the USD pairs. So we looked at order books, we looked at time and sales, we were very, very short-term day trading, scalping, looking for the initial impulse pushes, looking for 3, 5, 8, 10% moves, and looking for that first strong push after the retest. That's what we were trading. And in that circumstance, you're looking for something a little bit different. You're looking for very, very high RVOL, relative volume. You're looking for catalysts, some mainnet launch or something that's going to provide a catalyst that's going to push the price up. We do also look for these, but for our daily, day-to-day analysis where we're just looking for trades without seeing any catalysts, we're not looking for any fundamental announcements or anything, but there are times where we do look for fundamental announcements. But overall, on a day-to-day basis, we're just depending on the price action, the volume, which we talked about before. We're just depending on the chart to show us good entry and exit situations. But just talking about it in an example, we do incorporate fundamentals into it. Like for example, when we were shorting Matic, we saw that there was a mainnet that launched recently, and then the price went up some crazy amount. I think it was like 180% or something, but it basically went straight up. And for me, I saw that and I'm like, okay, yeah, there's a fundamental catalyst. Everyone's riding the hype. Everyone's wanting this project to be fully functioning for people to use instantly, which it's not. Like there's no project that is going to be that quick into actually implementing a mainnet and actually getting the project to be usable. So there's a lot of hype and distortion of price that I thought because of the catalyst, and that's why we were looking to short. There was a major catalyst that brought the price up increasingly exponentially, and I thought it was very, very overvalued, and the only reason it went up a certain amount and saw that price increase was the main catalyst of the mainnet. So then once this price started to drop and we saw breaking of supports, holding of resistances, lower highs, lower lows, market structure breaking, ascending supports breaking, once we saw the indications that the structure was failing, then we looked to short because we saw a catalyst on the way up. There was a lot of people longing. There's a lot of people already in late, like the FOMO people who are up when the price is already up like 80%, 100%, that were way late to the game. These people are going to be panic selling if the price drops. We know this. And we capitalized on this because of the people panic selling because they bought when the price was already up 50, 100, 75%. And we used the catalyst to our advantage to the downside because a lot of people saw the catalyst. Oh my God, mainnet is launching. The price is going to the moon, but we saw that as an advantage to take advantage of the people that were a little naive and bought the price when it was already basically at its peak at the all-time high, when the rest of the market was not seeing that sentiment at all. Like if you're looking at Matic when the price was seeing those 100% moves, the rest of the market was not seeing that bullish momentum in the pressure. There was just not a lot of bullish pressure within the market itself when that catalyst was occurring. So there wasn't really a reason for it to continue. And obviously we were speculating, we were right, it was great, we made good money, but at the end of the day, we're initially looking for A, the catalyst, and then B, the main thing we're depending on to actually enter and exit the market and for us to use every single time is going to be the TAs, going to be the technical analysis that we're using to analyze the market, to see what the risk is, to see what potential we have in the market, to see the take profits, all this stuff. So yeah, we do sometimes use FA, but the overarching structure, the overarching system, the method, how we actually navigate the market is going to be through our technical analysis. So yes, fundamentals play a role, but technical analysis is how we 100% understand the markets. And fundamentals do play a role, but yeah. Yep, definitely. definitely. Well said. Yeah, sure. So I'll just remove these here. So basically, where to find indicators, you want to put them on the indicators right here. We're looking for MAs, moving averages. And this is just basically going to give you an average of the previous X many candles. And we can understand the number of candles here. So for this one, we're going to do 50 and 200. So the first one, I'm going to make it white. And it's going to look a little bit bigger. And then the other one is going to be the 200. So that is, did I put 5? Yeah, I did put 5. And this is going to be the 200. And I'll just make that a little red. Make it a little bigger. So not yet. So basically, looking back all the way, I wonder how many times it crosses. Okay, that's pretty good. I got some good data here. Oh, that did not work well. Okay, so let's stick with the daily. So basically, we have two lines here. We have the white line and we have the red line. And let's just take a picture. And one is the 50-day, so the red one is going to be the 200, and then the white one is going to be the 50. But basically, what a moving average is it takes the average price of the last 200 or 50-day closes. So the red one is going to take the average of the last, the red one is going to take the last 200 days. So it's going to be a longer term, average. So it's going to average in more information, whereas the white 50-day will be only averaging 50 days. So it'll be more volatile because it's going to be more closely aligned with the current price because it's only averaging 50 days instead of 200, which is significantly greater. And what we're going to talk about is the crosses in that line. So this is the red line, which is going to be a less volatile, longer macro line, and then the white one is going to be a more volatile, shorter term line that's going to represent the data in a more shorter term. And then we have these crosses. We can see one right here and another one right here. And what these crosses signify is what they call a golden cross. And this is when the bigger time frame crosses the smaller time frame. And a bullish cross is going to be when the 50-day EMA, we can see that right here, when the 50 crosses above the 200, that is going to be a bullish indication. That is the golden cross, which is this one right here. And then there's something called a death cross, which is the opposite. And that's when the 50-day EMA goes under the 200-day EMA. And that is a bearish indication because now the short-term volatility is going below the long-term market macro, trend. And we can see that right here where the white goes below the red. And what we can use within these major crosses is to determine if the market is overall bearish or bullish. So we can use these with equity, we can use these with Forex, crypto, commodities, anything, right? So if the white line, the 50-day EMA, is over the 200-day EMA, we're looking for longs. We're looking for the price to appreciate, and it'll give us a bias to look towards the long side. Once we see the price break this zone and turn to a bearish indication, meaning that the 50-day EMA is under the 200-day, then we're looking for shorts. We're looking for the price to go to the downside. And what we can do is basically use that to create our bias. Now, personally, I don't love looking at moving averages. Like I said before, I don't really use indicators. I sometimes use tools, like I'll use fibs, but I rarely put MAs on a chart, moving average, or EMAs, exponential moving averages, on a chart. I mainly just stick with price action, but this is what a lot of people like to look at and use. There's a ton of people that basically just follow golden crosses and death crosses and basically Yeah, we could even, like, if we really wanted to, we could go back all the way to BLX and then go on the daily chart and really get a good understanding of that. Looks like a really bad BLX. That's not it. Oops. Give me one moment here. It's the first one. There we go. So let's just quickly look how many times. So we can see here, there's definitely not the perfect amount. But let's just look at the 2018, 2019 kind of situation here. So basically, if you're just going off of the golden cross, if you're only trading based off of the golden cross and death cross, meaning you're long when the golden cross appears and you're short when the death cross appears, this is where you'll be entering short. Let's get our different customizable pen. So you're going short at this point right here, meaning you're going to wait till the price, or you're basically going to sell, it depends. And then you're going to buy at this point right here. And then basically the next point you're selling is going to be at this point here, is your next sell. And then it looks like we are approaching a potential buy. We can see that right here. So if we are able to see that 50-day EMA go above the 200-day EMA, then it could potentially be another buy. But for now, we're still below it. So if we're just looking at golden crosses and death crosses, we see our first death cross right here, and we'd be entering here. If you're just looking at the golden crosses and death crosses, and then that's your entry, and then your exit would be basically at this point here. So we can see, obviously, it's not perfect. There is a lot that goes into it before the actual indication appears. And that's the thing with moving averages and exponential moving averages, and in my opinion, they are lagging. They're not forward-looking in a sense, but they do provide a map that gives some level of indication of what the retail and overall market is thinking, because like Nathan said before, a lot of people do follow moving averages and the cross of the 50 and 100, or there's different variations of how to get the golden cross, but 50 and 200 are the main ones that people like to look at. So yeah, that is golden crosses. Let's see if there's any other questions within the YouTube here. Thank you very much. No problem, Lewis. Fundamentals. Yeah, that's basically all the questions within the YouTube, and there's not much more within the Discord. So does anyone have any questions they'd like to get answered? Please put them in the Discord or put them in the YouTube. BTC looks like it's falling a little bit back down at this point. It's okay, we got a nice, good support. We got a very, very strong move to the upside, and our near support is going to be around 9,400. Yeah, definitely. It looks like that's holding as a support right now as a psychological zone of around 10K, but I wouldn't be too surprised if it pulled back a little bit, but overall it looks very, very bullish. No complaints here. Definitely looking for longs at this point. See a nice long wick on the 4 hour, so that's pretty healthy for the bulls. And then we do have even a smaller level of resistance, which could be a new level of support there. So basically doing step ladders on the way up, which is good to see. On the daily, not a whole lot happening. See, it broke out to a very nice clean new high, which is great. And then overall, looks pretty good. The CME futures definitely will see a gap up if the price does stick around the 10.08. If it does, because right now we're like $100 under. And let's see if we're getting any questions.
Yeah, definitely. I completely agree. It'd be interesting. It'd be interesting to see if BTC will start to become the actual digital gold, because we've been talking about it, which obviously makes sense from our point of view, but it's just, does the market believe that as well? And if it actually comes out to be true that Bitcoin will basically be digital gold 2.0, because gold in itself is only the value that humans perceive it to be, same as BTC, right? And gold is hard to transport. It's not really fungible. You have to melt it down. You have to break it apart. It's hard to manage. Yeah, right. It's not easy to manage for a day to day payment system, or really anything other than a store value. If you're going to buy like 10 ounces of gold and like leave it there for the next 2 decades or whatever, but if you are trying to basically hold value but actually use it, I would say Bitcoin is better in almost every situation, especially when the Lightning Network and the scalability issues start to become fixed by developers and engineers. But overall, I'm definitely bullish on BTC as well. Also, I just put in the vertical line that represents where the halving will be. It's not exactly right there. I think believe it is on the 14th of May, but that's the week that the halving will be on. And we can see we're definitely getting close to it. And I just want to talk about the halving for a little bit, because a lot of people think that on the certain day, like the day of the halving, the price of BTC will just jump immensely. It's not like a quarterly report or some catalyst where that day is going to be the day that the market shifts. And I think a lot of people have this misconception that it's kind of like a quarterly or annual earnings report, where let's say a company beats their earnings, the stock's going to basically jump instantly from the open to whatever the price is going to go, and it'll probably trade higher because then there's people buying it up. But it's not like it's a quarterly report where the price is going to instantly jump the moment that halving occurs. It's going to be a slow, gradual move up after the event, in my opinion. So let's just quickly look at the previous BTC halving in the past. I don't exactly know when it was off the top of my head. So the previous one, let's just look right here, was in July 2016, I believe, was the second BTC halving, July 9th, 2016. So let's just go to July 9th. July 9th. Let's just do July 4th. So we can see right here, yes, there was a little bit of a preemptive move to the upside, but we're not seeing like a massive shot up in volume. But what we're seeing is after the halving, which is right here, then we see the price discovery occur, because all it is just cutting the block rewards in half. It's not like BTC's like getting some Q4 report that's going to show its positive earnings. It's very, very different to equities. You can't put the same fundamental analysis on crypto as you do on equities at all. They're very, very different. Cryptocurrencies is a network. It's not a company that the purpose of its existence is to make money. Like Bitcoin's existence isn't to make money, right? It's to connect people that they can have transactions without any intermediaries or any third parties, basically, is what kind of the idea is. But you can't look at it in a catalyst sort of way that a quarterly report will be. It's more of a longer term price discovery approach, where initially, I am expecting some level of a move up here before our actual BTC halving. But what I'm really looking for is after the halving, let's say 3, 4, 5 months after the halving, because then we will really see the ramp up in price, in my opinion. I'm not expecting some massive bullish move right after May, and I'm definitely not expecting a increase before then. To be honest, on the weekly, I'm expecting a bit of a consolidation, kind of like we saw here. Maybe we'll see a bullish move closer to the event, but overall, I'm not looking to see this massive bull run appear until we break basically the all-time high, or at least the 15, 12-ish K range. And I've talked about it in the crypto market or Bitcoin market analysis before, but I think the price will hold this level of resistance, and we're going to get some level of ascending triangle before we move to the upside. So quickly just talking about the BTC halving, that's how it looked before, and that's kind of how I think it'll look in the future, where we're holding a nice ascending support. We will potentially see a little bit more of a bullish move once we get closer to the date, but the real bullish move, I think, will be after the date in the many months to follow, later half in 2020 and definitely in 2021. So definitely taking a step back and looking at the macro view of Bitcoin is a great idea. But to answer your question in short, Sen, I do think that 2020 will be a pretty bullish year for BTC, and then 2021 will be a significant year as well. Sort of like how 2016, 2017 went. 2016 was a very good year. 2017 was even a greater year. And just talking about the global macro health uncertainty of the market, we've never seen a global digital currency affect almost every country in the world while the global market is in a recession or even depression, if it gets to that point. So we've never seen anything like that. And basically, the monetary policies that the different countries have right now are in a place where they don't really have any more leverage. They don't have much more that they can use to try to combat the falling economy. So before, the monetary policymakers have really only two things that they can use to try to combat a depression or a recession, to try to get the economy back to its feet. The first one is to shift the money supply. So inject money into the system would be the number one thing that they try to do in order to try to stimulate the economy. This is a problem with inflation. So when the economy does get back on its feet and tries to become better, then they will try to burn money, try to take away some of that money supply, so the inflation isn't too crazy. The second thing they can do is to try to increase or decrease interest rates. So basically, if it's trying to stimulate it, they try to lower interest rates to try to increase borrowing and try to increase the supply of the borrowing and lending that's happening within economy. So those are only the two things: increase money, decrease interest. What they've come to a point where they have basically lowered interest rates so much that a lot of countries are in the negative before this massive crash even occurs. So look at places like Italy, Japan, Denmark, Switzerland, Germany. All these places have negative interest rates, meaning if you put in your money into a bank, the bank is charging you for loaning the money, which is crazy. It's never happened. This is brand new monetary policy that's never been tried before in history. This is brand new, so they're just basically saying like, hey, this could work. This could potentially promote spending and lending. And it actually came out to be that it actually is making a worse impact than it's actually promoting it, because then people are just hoarding cash because they don't want to put it in banks, and then banks get squeezed, and then they don't want to lend money because there's no more people putting money in banks. There's a whole shitstorm, and it's not very beneficial. And then the other way is printing money. And they've been doing this so much recently, ever since 2008. Look at Japan. They've been printing a shit ton of money, and they haven't been able to end the slow deflation because the demographics in Japan is just so bad. There's really no amount of people that are being born. The infancy rate is at its lowest point ever, basically, since like the 1900s. And there's no new people coming into the workforce to support the aging population that requires workers and able to support them, because obviously a lot of people haven't saved for their retirement, and the older someone gets, the less they're able to make an income. So then the younger generation has to support the older generation, but there's a lack of the younger generation able to provide that help for the older generation. So there's a lot of things coming into the current macro view, in my opinion. I really like to follow the macro analysis, but in my view, I do think that BTC and crypto and blockchain as a whole will be a very, very disruptive emerging sector that will play a very critical role in the years to come. And in terms of not just the price appreciation of the assets, but also what they will provide for the future in terms of voting, in terms of supply chain management, in terms of hospitals, and there's so many things that it will actually impact. Even talking about like random things like Airbnb will be disrupted by blockchain. Uber will be disrupted by blockchain. Even like simple day-to-day companies they don't even think will have an impact from blockchain. Like Uber could create its own blockchain and it can have its own ecosystem, creating its own currency, and then people can speculate on the currency of Uber. And then Uber doesn't even need to be a thing anymore, because then it's a decentralized application that, there's no single entity taking a portion of the cut. It's a whole thing. I don't want to ramble on too much, but overall, I do think that the market is very, very interesting. It's still in its infancy, like Nathan said, but there's a lot of projects that are coming into play in 2020 and 2021, and we're very excited to see what the future holds. Yeah, that was a little. I definitely get into my rambling when I'm talking about something that excites me. So yeah, like if anyone has any questions, definitely please put them down now. I don't see any. Oh, I do see one on the. So how do you think Bitcoin will behave during the financial crisis? Is the last one. We kind of already talked about it. We could talk about this for a very long time. Obviously, no one has a crystal ball and no one can exactly understand. But if you're comparing Bitcoin at least to another safe haven asset like gold or silver, or another asset that holds its value during financial crisis, and also is a non-correlated asset, like things like stocks and real estate are generally correlated, meaning that they follow a similar structure and market structure when the price or when the fundamentals are doing something that would make that price go in a certain way. Bitcoin and gold are non-correlated, so they don't follow the same price movements as traditional assets. But we've already talked about that. We're not going to get into it too much. If you would like a further detail and if you'd like to talk to us, join the Discord, hit either Nathan or myself up, and I can actually have a one-to-one discussion with you of what I think could occur in the markets. But I don't want to drag this on for too long here. Yeah, exactly. Yep, exactly. So, yeah, thank you very much for coming to our first one. Thank you very much for being within our community. We really, really appreciate every single one of you who are coming in, contributing some knowledge, even if you're an absolute beginner. We really enjoy being friendly to people and trying to provide good education for you guys, even if it's absolutely for free. We are here to help. Yeah, definitely. I think everyone knows what the Performante Premium subscription is. I'm not going to get into it, but yeah, thank you very much. We really appreciate it. We really appreciate everyone being within the community, and see you next time.